Hi everyone, this is Matt Whitbread. This is my midterm presentation here for the project for the business cycles project that we're all working on. So it's not complete yet, but this is kind of an update in terms of really what I've done so far, kind of the framework I'm following, and then really how I'm trying to get to some of the conclusions here. So we'll start off with basically the framework of what I'm trying to get at within this study. So what this chart shows is the year-over-year percent change in industrial production versus U.S. equities, proxied by the Wilshire 5000. So this goes back to about 1972, and the Wilshire equities is in blue, industrial production is in orange. So really, the big kind of takeaway within this chart, what I'm trying to show here is there's a pretty clear, although not perfect, but pretty clear relationship between industrial production and equities, which is a fairly understood metric or phenomenon within economies, and it's we've seen it in the fact that equities tends to be a leading indicator of GDP, whereas industrial production is a coincident indicator, which we'll get to, which is pretty important in terms of how the relationship breaks down. But it's a pretty well understood relationship, and I think it can be most easily proxied by the fact that industrial production tends to be really the cyclical component of economic output, which is why the cyclicality of equities kind of comes through and matches it. So really what we're showing within this chart is the fact that although it's not perfect, the turning points and the big swings between the two are generally matched. So you can look at 2008, you can go all the way back to 1974, 1982, and 2000. Again, it's not perfect. A lot of interim periods, there's a lot of noise within the chart. But broadly speaking, there is a significant relationship. But the other important aspect of this, as we mentioned before, with leading indicators, is equities tends to lead industrial production. So the question is, how much does it lead? So I put together this is what's called a cross correlation. So really what this shows is the correlation between the year-over-year changes in industrial production versus equities with different lags. And the correlation rises to all the way up to about 5.56, 0.57 thereabouts, um, at about a 6 to 7 month lag. So essentially what we're showing here is U.S. equities tends to lead industrial production by about 6 to 7 months based on this simple correlation. Again, it's not perfect. The correlations are never going to be super tight because there's so much noise within this, but this is really, really what I'm looking at here. So the goal of this study of mine is to be able to try to forecast a leading indicator for industrial production, but do it within enough of a lead, whereas I'm essentially leading equity markets. Because if I came up with a leading indicator for industrial production that only leads by 3 months, and if that information is already reflected within the equity markets, then I really don't have anything to exploit from an investment perspective. But if I can lead industrial production by, say, 12 months, or maybe even just 9 months, then theoretically I'll have a steer in terms of where equity markets might be going over the next few months and be able to allocate risk assets accordingly in a somewhat tactical manner. So that's really the crux of what I'm trying to get at here, rather than just simply just forecasting industrial production. So the framework in terms of how I approached this was to isolate what I thought were the um, most important demand cycles that really underpin industrial production. And this was a bunch of research and so forth, and paper support, broadly speaking, a lot of these things. But I was able to come up with 5 general, what I call demand cycles. So there's the housing cycle, the automobile cycle, or car purchases, corporate structures, which essentially is plant and property, business capital expenditure cycle, business spending. So that's equipment, software spending, computers, and so forth. And then lastly, the inventory cycle. So um, the interesting thing about all these different demand cycles is they have very different frequencies as well as amplitude. So, for example, the housing cycle and the corporate structure cycle are much more long-term in focus, anywhere from maybe 5 to 15 years in terms of the duration for the cycle, whereas the inventory cycle is probably a year to year and a half. So, very different in terms of the duration of the cycle, but then also the magnitude. So far, my research has shown the fact that the housing cycle is probably by far the biggest driver of industrial production among all these cycles, because it has a very unique wealth effect on the consumer. So as the housing market struggles or does really well, so tends to go consumer spending as well. But the point is um, the hope is to create a leading indicator based upon a number of metrics that forecast or get ahead of these basically demand cycles. And within that leading indicator is we have, where there's real information, I think, is when we have all these cycles that start to kind of line up with one another, and it looks like there's a significant opportunity either within the equity markets or forecasting industrial production. So that's really the demand cycle framework. So this is meant to illustrate the framework in terms of how I started predicting turning points. So I followed a very simplistic kind of technical indicator for all these cycles. So starting with industrial production, I essentially just used, so this is a monthly data, but I used basically 3 consecutive quarterly declines in industrial production as my indicator for a recession. And it goes all the way back to 1919, and I'm showing here the fact that you can see that the gray bars being the recessionary periods line up pretty well in terms of the dips, at least the major dips within industrial production. So even though it's a very simple technical indicator, it still actually behaves fairly well. And simplicity was kind of important to me in terms of kind of matching up all these other turning points. So what we're showing here is the housing market turning point. So this is housing starts in the thousands. A couple interesting things about this. One of which is you can see that there is a significant cyclical notion to this. Now this is marginal houses, they're new houses that are being added to the economy, but this is a very cyclical as well as fairly volatile time series with different frequencies. It's interesting because in the 70s and even the 60s there was a much tighter cycle, and you can see that into the 90s and after that there's been a much more prolonged long-term trend in terms of the housing market cycle. So the cycle is actually kind of lengthened out quite a bit. It could be due to any reasons. It could be monetary policy. It could be inflation. It could be demographics, or who knows. But that's not really the point of the study. Really, what we're showing here with the turning points is the turning points actually does a pretty good job actually of hitting the significant downturns, or I should say the peaks, ahead of the large downturns in the housing markets. But there are some false signals. 2018 is a good example, 96 and 1999, although 99 was fairly small. But the 80s is actually a pretty good indicator of a period where the housing market was significantly weak, according to this, at least in a very prolonged recession, but industrial production didn't suffer. And that's what we're showing here within this slide. So the housing recessions are shown in orange, but the industrial production recessions are shown within the gray sections. So again, if we look into the 1980 section, it's interesting to see there's a very long, prolonged, quote unquote, housing recession based upon the technical indicators, but there's no coinciding industrial production recession. And all I really take away from that is the fact that I think that that's the importance of the different demand cycles. It's highly likely what's happening within this period is that there's another demand cycle that we had already discussed before that's essentially supporting industrial production while the housing market is essentially weakening. But the other aspect of this that's interesting is you can see that when they do match up, so there are a couple of false signals, but ignoring those, for example, the big housing market declines, the early 80s, the 2008 being very big, and then 2001 and so forth. Housing starts lead industrial production, the turning points. So this was pretty important. I thought this was a really interesting kind of way to illustrate it and kind of prove the fact that there is forward signaling within this metric from industrial production. The question then becomes, is it enough for to get a signal on equities? But if we look to business spending or CapEx spending, we get a different story. So again, it's the same principle here. The orange indicates when CapEx spending is in a recession. Again, same indicator, but the gray is when we have an industrial production recession. So if we looked at 2008, because it's a very noticeable period in terms of significant decline in CapEx, industrial production actually peaked ahead of CapEx spending. So this is not the relationship we're looking for. We're looking for something that's going to lead industrial production, not necessarily lag it. Some instances it does lead in the 2000s as well as the 2015 period. The other tricky part about this is we don't have a lot of data going back prior to 1999, or I'm sorry, to 1990. I had to proxy CapEx spending because I had quarterly data based upon fixed investment coming out of GDP, but I couldn't really use the quarterly data. It went back further, but it just wasn't gonna work from a lead indicator on the frequencies that we were looking for. So I proxied it. So we don't have a lot of data to look at, but I still think that this is a very important cycle. So my thinking with this and my thinking with all these cycles was to say, well, we can look to see exactly if there's lags, but that might not be the entire story. So I looked a little further into the CapEx side and this notion and kind of created this notion of excess supply. So what we're showing here is a metric of excess supply that is essentially a phase trend of CapEx. I believe it's 36 months. So fairly short-term phase trend. And we're looking at the difference of CapEx spending versus the phase trend. So we're kind of isolating that cyclical component of CapEx versus the trend. Now, the point of this is to try to isolate when there's perhaps excess supply or an overspend or underspend on CapEx and what the implications might be going forward in terms of what's going to happen to CapEx in the future. So what's interesting from this is you can see, so again, this is showing the CapEx recessions that we defined before. And ahead of every single CapEx recession, there was significant run up, some larger than others, but a significant run up in excess supply. So the way I interpret this pretty clearly is the fact that, like anything else, be it inventories or whatever it might be, when supply starts to outstrip demand, demand being proxied by the trend, then you start to see an oversupply coming into the market of whatever that might be as businesses start to adjust to a lower demand than they perhaps forecasted. The capex starts declining and starts going in the other direction in terms of a growth. That is going to have implications on industrial production. So this is what I consider to be kind of what I call a state variable within this, or it's a variable that it is state dependent in terms of where the supply looks at within the market. So this, I use this as an example here because it's really illustrative of the fact that the actual trend itself doesn't show a significant lead all the time, but what does show a significant lead is this excess supply and then undersupply, at just as much, because as you can see in 2019 when we started to see capex start to rebound, or I should say that the recession ends, coincides with a significant underspend in capex that started to correct itself in 2009. So these are the general frameworks that I'm putting together for your leading index. As far as the next steps in this point, I'm trying to incorporate that same supply metric that I showed in CapEx within the rest of the demand cycles that I have. So the business spending, inventory, housing, automobile, and so forth. Because automotive is another good example of one that really didn't show a really consistent lead lag relationship with industrial production, surprisingly, but that supply metric, I believe will help that quite a bit. So then we'll just use those variables to create a leading index, evaluate the leading index based upon the criteria that we've looked at, the 6 main criteria, and then also create a diffusion index, because I think that's important given the fact that we're looking at multiple cycles here. As I mentioned before, I think it's important to get an understanding of how well all the cycles line up with one another in terms of quote unquote the strength of the signal going forward, and then use that framework to essentially backtest how this would have worked in predicting equity, in predicting not just industrial production, but also predicting equity market performance. So that's where I stand right now within the project. I hope you all found it was interesting, and still quite a bit of work to do on it at this point, but getting close. So that's it. Thanks, everyone.